Okay, hi. So I think today will be an online session for our ICMF 425 classes, right? So as I kick off the case cracking activities with you in class, right? And you have done all of the cases. I think today will be the session and I will provide some of the guideline answers for the case cracking review activities, right? So as I mentioned to you in the class, there's no right or wrong answers for this case studies, right? So I hope you enjoy the case writing activities and let's go through the key questions first and I'll go through the answers accordingly, right? So based on the case activities, there are approximately 7 questions for you to solve, right? So as I mentioned to you before, the first 6 questions will be the question that provide guidelines for you in order to identify whether or not the Ivory Homemade Group, which is the case company for this exercise, should go or not go to IPO, right? So I believe that some of you might decide that the company should go IPO and some might not, right? So let's see my answer and let's compare with your team answers, right? And as Ajanti report has mentioned in the session, right? So uh, the the case cracking activities, the form of the case might be relevant to what will be in the final examinations, right? So maybe if you have done your cases with your group and maybe listen to uh this this video, maybe that will help you as a form of how to study for the final examinations, right? Okay, let me start the session. Okay, so let me go to the case questions first, right? So as you can see in these questions, I have listed for you, right? So the first 6 questions will be maybe on different topics that you have learned before in these classes, right? So the first one will be on the revenue framework, right? So as our course intends for you to do the financial modeling, right? So the first one you have as a guideline for you. Like let's say, for example, I give you a company, how you structure, how you use the financial projection, right? How should you draw the revenue structure, right? I will share when I go through the answers for this part, right? The second one will be related to the calculations of the cost of capital, right? So I think in this case, it is quite straightforward. You know the formula already, or you can search on the internet already, right? What will be the formula for cost of equity? What will be the formula for the WACC? However, the challenge on this question is how to select the most appropriate key financial information in which you can find anywhere in the internet, right? But which kind of information you need to choose to do the WACC and cost of equity for this particular company, right? That may be the challenge for it. Number two, the third one will be on the assumption justifications, right? So as I mentioned before, when I was in IB, right, the most challenging part will be on the assumption part, right? Not how you balance the three financial statement, right? So for this one, I want you to take a clear look on which type of assumption is most appropriate for every homemade to do the IPO valuations, right? So for number three, I will give you differing valuation result, right? Ranging from a very low amount to a very high amount, right? And the difference between all of the valuation amount depends on what the assumptions are, right? So your task was to select the most correct to believe the analysts that have the most accurate assumptions based on the theories that we've learned based on the company characteristic of the case company, right? So this will be number three. The fourth one will be on how you apply the football field analysis or tools that you have learned in this class in real life, right? So which type of information might be required to construct a football field analysis and how you interpret the football field analysis result, right? That will be objective number four. Number five might be related to uh, PS peer analysis, right, for multiple valuations, right? So the first four questions will be related to DCF or financial modeling, right? For number five, it will be related to multiple valuations, right? So the key for multiple valuation isn't until yeah, you need to understand for what is PE, what is EV per EBITDA, something like that, right? However, you need to be after you understand that, you need to be able to identify the most suitable peers in order to know what should be the industry PE, what should be the industry EV per EBITDA, right? In order to have a good proxy for industry PE and industry EV per EBITDA, you need to know first who should be your peers for that particular industry, right? So you need to take into considerations multiple various aspects of the companies, right? Whether it is business model, its key customer segment, its key financial, the business sizes, market capitalizations, something like that, right? You have learned all of these concepts before, right? But how to apply it is more important. Okay. Number six, maybe this is a bit unique for this class, right? So we have never learned about M&A before, but when you consider going to IPO, right? One the objective of the companies or maybe the investment banking firm is how you convince the investors to buy your company's shares, right? One of the ways to buy some asset, whether it is company's share or maybe a fixed asset, right? To for a company to be big before you go IPO, right? One of the things that I believe might consider doing if Kun Pla, the owner wishes to go IPO, is that maybe they might consider buying its own restaurant Thong Smith to be under Ivory Homemade if it were to go IPO, right? It is one of the, I think, interesting questions to ask, right? And I would like to guide you through the appropriate step. What factors you need to consider before deciding to buy companies before going to the IPO, right? So these are six key questions, right? And each of the six questions are quite unique, right? And after you go through all of these six key questions, right, in which was a question that most IB analysts should go through before making the decision whether or not to recommend Kunpla or the shareholders Ivory Homemade, whether or not they go to IPO, we should understand all these aspects first in order to answer the last questions, not whether or not the company should go IPO, right? So let's see my answers during the end of the session, okay? So let me go through the questions case by case, okay? Let me go to the first one first, right? Okay. So the first one, I think each of the group will have different answers, right? So let me share my answers on the revenue forecast model for Ivory Homemade, right? So for me, I think we can separate the forecast revenue of Ivory Homemade into two key parts, right? So for me, I will separate first into revenue from existing brand and the revenue from new brand, right? In order to be mutually exclusive, collectively exhaustive, MEC's concept that may have learned in consulting class or business class before, right? So if I separate into these two branches, we can clearly, okay, one part would be for existing business. You know already which are the brands, how many number of restaurants that Ivory Home may currently have, right? You know, and you can forecast that as a first part, as you can see here, right? However, if you only consider this, you will not consider a potential upside from Kunpa opening new Thai restaurant, right? So I believe that there's no doubt that she is planning to continue to open new restaurant going forward, right? So I think in order to fully capture all the business potential of Ivory Homemade, we need these two key streamline revenue, right? Okay, let me first start with the easy one first, right? So revenue from existing brand, right? So for existing brand, okay, 400%, they will continue with the existing branches or current branches, right? You know already how many branches that Ivory Homemade Group have. Even though the type of restaurant is different, right? It is composed of Ivory, it is composed of other sweet store or Mugata store, for example, right? There are different types of branches, and each of the restaurant have different branches, right? However, for simplicity, you can consolidate all of the branches into one number. Let's say 100 branches, right? After that, you might consider multiplying with the average revenue per branches, right? So for average revenue per branches, you can find it by dividing the total revenue of Ivory by the number of branches, existing branches, right? You will know by approximate how much revenue per branches that Ivory made in 2024 or 2023, depends on the available information you have, right? Yeah, so I think this one is quite straightforward for the current branches, right? However, another branches that is quite critical also is that, okay, you have the know-how, you have the intellectual properties on the existing restaurant you open, right? However, there are also potential that they will expand the number of the branches for its existing brand also, right? So they may consider opening more Ivory store in other provinces apart from Bangkok. That's also possible, right? So in this case, there's also upside from a new branches from existing brand also, right? So you need to forecast how much of the new branch will, if the company is open based on existing brand, right? So this will be another revenue stream also, right? So based on these two things, right, you will know how much will be the revenue of existing brand going forward, right? So this will be the overall for part one, right? The second part will be revenue from new brand, right? I think this is quite challenging, right? So you need to guess how much of the companies will expand going forward in the futures, right? Maybe you can look in the past how many new restaurants that Ivory Homemade could be able to open every year in the past, maybe in the last few years, right? If, for example, they can open two new brands per year. Maybe you can use two as a proxy for the number of new brands for later years. That is possible also. However, if you believe that the Ivory Homemade is in a mature state, they cannot expand much more. Like they cover most of the cuisine already, right? You maybe consider way more conservative on the number of new branches, right? Okay, after you consider this one, you might consider multiplying with the average branches per new brand, right? So you can look at it in the past. If Ivory Homemade opens one brand, right? How many branches they will open per one restaurant, right? Personally, I believe that you can look at the past, based on historical opening library. That is one thing you can do, right? However, one thing to consider is that every type of the restaurant, maybe they have differing business potential, right? So for example, let me give you a hypothetical scenario, right? So for example, if you were to open Ivory, right, in which that Ivory, the yellow restaurant, right? So I think it is quite mass a bit. Maybe it's a bit premium, but it's quite mass, right? Maybe you can open at the maximum of 20 store. However, on the other hand, if Kun Plat said, I will go at a very niche strategy, I will open a fine dining restaurant. Personally, I am doubt that the companies can be able to open 20 store, right? So maybe you need to take into consideration these factors also in order to define the numbers of branch per new brand, right? And lastly, average revenue per branch. I think this one you can use the similar assumption as you find for current branches, right? So this would be my revenue model, right? One thing I want to emphasize is that when you create this kind of revenue model, be sure that you can be able to find the numbers or give a forecast based on your storyline of your financial projection, right? For each of the cells in this image, right? So if you can, maybe you may need to consider to redraw or redo this activities, right? Because after you finish this, the next step is that you need to find the numbers and do the financial projection, right? So that'll be the key takeaway that I want to give you for revenue forecast, right? So as I mentioned to you before, we have launched this exercise before, and this was one of the example that I think is quite good from the previous class that I taught here before, right? So in this case, the revenue model is quite different from my version, right? So this group, they didn't separate revenue into two parts, the revenue from existing brand and the revenue from new brand as I do, right? So for this one, they view Ivory revenue as three key mainstream, right? So they will, okay, the first key mainstream is ice cream with a unique product. That is the group point of view, right? Another mainstream is from the savory food restaurant, right? So they include khao tom, original Thai food, yum, Thai spicy yum, right? And noodle. They view it as the same category of restaurant. So they combine it together, right? And lastly, will be cloud kitchen, which is a separate business model, right? And this could be tried to identify uh, every key business lever that might impact the revenue from each of the business, right? So it is quite different. So based on the story of this group, right? So they view that these three business, ice cream, savory food, and calculation, have very different business model, right? So how to calculate the revenue for each of the part should be also be different also, right? So I think theoretically this group, they'll do a very great job in doing the revenue structure, right? However, one point, as I mentioned to you before, is that it is quite challenging for you as an outsider that you don't know every key operational matrices of Ivory, right? So if if you draw this kind of revenue uh, structure, right, it is quite, for me, I think it is quite hard for you to find the numbers for each of the cell, right? Yeah, so that may be one of the challenges. So be sure to take into consideration the possibility of you getting the numbers for these of the assumption also in doing the revenue structure, right? So this will be the key takeaway. So I think there is no right or wrong answers for this exercise, right? But just want to emphasize on the concept when you do the revenue structure, what are the key things that you need to consider, right? So the revenue structure should be mutually exclusive, collectively exhaustive, MECs first. Second is that you need to ensure that based on revenue model, you need to be able to find the supporting information, right? Or supporting financial information to fill in and be able to construct a financial model and get the final revenue for each of the year going forward. Yeah, so that'll be the conclusion for this part. Okay, let's go to question number 2. So this one will be related to WACC and cost of equity calculations, right? So based on this, so I simplify things for you, right? So I find all the information that might be required to calculate the WACC and cost of equity for Ivory Homemade, right? However, there are some information that might not be used in order to find the cost of equity and WC or Ivory groups, right? So you were given this table, right? So the area that I highlighted in green were the information that you should have been used to calculate these two financial matrices. However, the key assumption that I didn't highlight in green, those were the assumption that should have been used for every homemade calculations, right? So please cross check whether or not you have used the assumptions that wasn't highlighted in green, right? So let's start with the answers first, right? So the answers for this question will be the cost of equity will be equivalent to 10.2%, and the WCC will be equivalent to 9.1%. Right. So yeah, as I mentioned before, not all the information given in the case will be used to calculate the numbers, right? So let me go through each, each, each of the matrices, right? So for in this case, cost of equity, right? So the formula for cost of equity is quite straightforward, right? So the cost of equity will be equal to risk-free rate plus the equity risk premium time with the levered beta of the company, right? So let's start with the easy part first, so the risk-free rate, right? So in this case, I have two types of potential risk-free rate that you can choose. The first one will be the 10-year government bond of all world countries, right? All countries in the world, right, which is 4%. And then another choice would be the 10-year Thailand government bond, which is 3%, 1% lower than the global version, right? So in this case, if you go back to the case company, you can see that Ivory is a Thailand-based companies, right? So in this case, I think it's quite straightforward for you to choose the average 10-year Thailand government bond as a proxy for the risk-free rate for this case, right? So based on my answers, the risk rate should be 3%, right here, 3%, okay? The next factor that you need to consider is the equity risk premium, right? So equity risk premium is calculated by the equity return of the market minus the risk-free rate, right? So in this case, you know that the risk rate is 3%, right? So another factor you need to find is equity return of the market that is most suitable for your case company, right? So in this case, I also have two equity return also, right? First one is set index return, which is 9%, which might not be the case currently, right? Maybe it's minus something, right? Maybe it's like index within the 5 to 10 years. However, okay, let's imagine it is 9%. Like be very optimistic. Yeah. And another one will be the equity return for MSCI World Index, which is 7%, right? So in this case, I think the concept also applies for the risk-free rate, right? This also applies too, right? So you need to, since Ivory Homemade is a Thai company, you should use the equity return of that index, right? Which is 9%, right? You know that equity return is 9%, you need to minus 3% of risk-free rate in order to get 6% as equity risk premium, right? So you know two factors now. The last factors might be a bit tricky. So the last factors would be the levered beta of Ivory Homemade, right? So based on the case company, I didn't give you directly the levered beta of Ivory Homemade, right? So in this case, you need to look at the unlevered beta of the industry of Ivory Homemade, right? So I have four types of beta in the table, right? So unlevered beta and levered beta of two industries, tourism or restaurant industries, right? So I think one thing to choose from is that whether or not you should use the beta of the tourism or restaurant industries, right? So for in this case, I think it's quite straightforward, right? All the business model of Ivory Homemade is in the restaurant business, right? So ideally should use restaurant business, right? However, some may argue that the majority of revenue for Ivory might came from might be related to the popularity of the Thailand tourism, right? Since some of the brand, like for example, 𝗏𝗏 most of the customers were Chinese tourists, right? That is also possible explanation. However, if you were if you don't have any information related to restaurant industry, maybe tourism industry might be a good second choice for Ivory Homemade, right? However, if you have restaurant, maybe that might be a better choice for this case, right? Okay, if you know that, okay, we should use the restaurant industry as a proxy, right? Which type of beta you should use as a baseline first, right? So in this case, you should use unlevered beta of restaurant industry first, which is one time, right? After that, you will need to use the Hamada model, right, in order to convert the unlevered beta of restaurant industries into the levered beta of Ivory Homemade, right? So by doing that, you need to consider the unlevered beta one time, and you need to look at the optimal capital structures of Ivory, which is equity 80% and debt 20%. right? So in this case, you can calculate and the last assumption you need is the corporate tax rate of 20%, right? So these are all the key factors that you need for the Hamada model in order to calculate the levered beta of every homemade, right? So the calculations came to 1.2 times, right? So based on these three factors, I arrived at the cost of equity of 10.2%, right? So this is the overall cost of equity, right? Okay. Next one might be a bit complicated, but not that complicated, right? So this one will be cost of debt, right? So based on my check on your assignment, maybe some of you might use a synthetic cost of debt, right? So that is also possible also, but there's a pro and con, which I will cover later. However, based on my answers, right? So I didn't give you any specific uh details on cost of debt, right? So the only way you can find the cost of debt is to look at the company's financial statement, right? So in this case, one way to find the cost of debt is to look at the interest expense of the company in the profit and loss statement first, right? So in this case, based on the latest year financial statement in 2023, the interest expense was approximately 18 million Thai baht, right? If you want to find a percentage of interest expense, you need to also find the total interest bearing debt, right? So in this case, I already have three types of interest bearing debt, right? So the first type will be the bank overdraft for short-term loan, which is 16 million Thai baht, right? The second part will be the CPLTD. So this might be the a very weird abbreviations, right? But CPLTD stand for current portion of long-term debt, right? So or in other words, it will be the long-term debt that will be due or the company need to be paid within 1 year, right? So this is called CPLTD, which is a part of current liabilities. So in this case, the CPLTD is 31 million, right? Which might not be the large chunk of the company's interest-bearing debt. And lastly, long-term loan, in which will be the majority chunk of the company's debt, 273 million, right? In total, the total company's interest-bearing debt is 321 million Thai baht, right? So if we divide interest expense with interest-bearing debt, you will get the cost of debt before taxes of 5.6%, and after tax, so I multiply 5.6 with 1 minus 0.2%, so 0.2, I will get the cost of debt after tax of 4.5%, right? So this will be the cost of debt of our every homemade, right? So you know every factors, right? You know the cost of equity, you know the cost of debt, right? And you know the target capital structures of every homemade, in which the proportion of equity is 80% and the proportion of debt is 20%. You are well to find the efficiency of hybrid homemade, in which will give you 9.1%, right? So this will be the answers for questions number 2. Okay. Next, next there will be the synthetic cost of debt, right? So as I saw, you use this kind of calculation for cost of debt, right? So I think it is fine, right? So if you have based on the case study, I didn't give you the model and synthetic rating table, right? So I didn't expect you to use this method as a way to calculate the cost of debt, right? But however, this case is also possible, right? So you can explore the internet and you can use this case also, right? So for example, if you select this the model and rating synthetic rating table, right, and you apply the concept of synthetic cost of debt, right, you will get then first of all, for the concept of synthetic cost of debt is that you identify the spread of the company based on the interest rate coverage ratio of the companies, right? So in this case, you have the financials of the companies, right? So you have the company's EBIT of 537 million, and you also have the interest expense of the company of 18 million, right? So in this case, you can easily find the interest coverage ratio of approximately 30 times, right? So you know that the interest coverage ratio is 30 times, right? You go to the Moderan's synthetic rating table, right? And you can see that, okay, the spread for interest rate coverage ratio more than 8.5 for high market cap firms, which might not be the case for every homemade, right? Since the market cap quite low, especially in the global terms, right? You may maybe consider looking at the left table, okay? So our case, company have interest coverage ratio 30 times. However, the interest coverage ratio uh for the first step will be 12.5%, right? So in this case, the implicit rating will be AAA, and the spread will be 0.75% for this company, right? So in this case, if you add up the spread of a bond rating, which is 0.75, with the with a risk-free rate, which is the average 10-year Thai Nai government bond 3%, you will came out with the cost of debt before tax of 3.8% and the cost of debt after tax of 3.0%, right? So this is might be one of the potential answers that you might give for cost of debt, right? So I think it is fine. You can use this method to calculate cost of debt, right? However, I personally doesn't recommend you using these methods in reality, right? So personally, let me share you my experience, right? So when I was in IB, I never used this method before when presenting the figures to the client. Why, right? Since even though it is taught in this class, right? Let me tell you why we shouldn't use, right? Let's talk about the pros and cons first, right? So the pros, I think it is one of the methods that you can take into consideration the probability, the bankruptcy of the companies in calculating the cost of debt, right? So so how did you consider the probability of bankruptcy in using the synthetic cost of debt, right? So we consider the interest coverage ratio of the companies, right? If the interest coverage ratio is very low or very close to zero, right? This signifies that the probability of bankruptcy is quite high, and therefore the rating will be very bad, maybe C or D, and therefore the spread will be high, right? So this is one pros of, and I think the only pros of synthetic cost of debt, right? So if your company has a probability of bankruptcy which is very high, you will have a very high cost of debt, right? So this is good, and this might be one the only pros for synthetic cost of debt methods, right? However, there are a lot of cons, right? So the first thing, and I think the most straightforward, is that there are multiple table like this on the internet, right? So why should I believe in the Moravan's version? Why should I believe in other professors? Let me show you here, right? Why should I believe the table on the right hand side? Why should I believe the table on the middle, or why should I believe the table on the left hand side, right? There's no theories behind it. Every professors or every financial service firm that do this kind of spread tables, they have different underlying assumptions, right? And each of them do this table at a very different time period, right? So it is quite challenging which one you should stick it in order to identify the synthetic cost of debt, right? Another challenge is that this one is for global scale, right? We didn't have the synthetic rating for Thailand, right? So that is one of the challenges too, right? So so my first con is that there are a lot of baseline for you to stick on in order to calculate the cost of debt, right? So it is quite hard for you to convince the public investors or the client, right? Okay, I prepared the cost of debt based on the model run. They might ask you back, who is the model run? Why we should believe in its table, right? So this might be challenging. Maybe it is better for you to explain, okay, I find the cost of debt based on the historical financial statement of the company. That may be much more straightforward, right? And it is more, personally for me, it's more reliable, right? You stick with the actual financial statement, and that was a true cost of debt that the companies currently pay, right? And the last con is that base maybe this might be one of the things that the pros might not address, right? So the pros is, as I mentioned before, is that you use interest coverage ratio as a proxy for you to identify the probability of bankruptcy, and therefore identify the spread of the companies, right? However, interest coverage ratio isn't the only proxy for to identify the probability of bankruptcy, right? So there's a possibility that you have a very good interest rate coverage ratio, right? But you have a very bad capital structure. It is possible that you have, let's say, 10 times interest rate coverage ratio, or maybe 29 times interest rate coverage ratio. But if you look at other matrices, like for example, capital structure, percentage debt, and percent equity, you might have 90% debt, 10% equity, right? So if you look at another uh, financial ratio related to the capital structures, right? You might have a worse financial ratio in which haven't been covered by the synthetic cost of debt table, right? So this is another cons also for this methods. Okay. So yeah, I think that will conclude the second question. So I go through how you need to how do you select the assumptions, right, that you should use in order to calculate a firm's cost of debt, cost of equity, USCC, right? And I've gone through you the what are the pros and cons of the synthetic cost of debt, right? In which what one of the methods that we have taught you in this class also, right? So this would be the conclusion for questions number two, right? Okay. let me go to this one is question number three, right? And it is and this one is quite challenging, right? So in this one, I give you the IPO valuations of six analysts, right? Analyst one is analyst six, right? And the IPO range of analyst one to analyst six is quite very broad, right? So the lowest valuation will be 6 billion Thai baht, right? And the highest valuation will be 20 billion Thai baht, right? So approximately three times 3x difference, right? So there should be some very major differences in the assumption that was used in the financial model, right? So first of all, in this case, you need to identify first which of the analysts you believe, right? And later on, you need to find the IPO price per share of the based on the valuation result of the analyst that you believe, right? So let's say there are five key assumptions that you need to choose, right? Okay. So let me go through by each of the assumptions first, right? So in this case, the first assumption will be the type of cash flow used, right? So in this case, you have multiple options. If FCFF, you have FCFF and FCFE, right? So in order to identify whether you should use FCFF or FCFE, you should go back to the question: what are the objective, or what are the outcome that you're trying to find, right? So if you were to find the firm valuation of the company, you should use FCFF, right? But if you want to find the IPO valuations, or in other words, equity valuations, you should use FCFE instead, right? However, you might have a counter argument, right? That you can also find IPO valuations or equity valuation by using FCFE and convert it into IPO valuation. That is also possible, right? But if you were to choose one case, better to go with FCFE first, right? So based on this, you can eliminate analyst number six as the correct answers, right? This will be the first assumptions. The next assumption will be on net profit growth assumptions, right? So we stand here in 2024, right? And we are going to forecast going forward during the next 3 years, right? How much should be the net profit growth assumptions for Ivory Homemade, right? So I think you can make it up, right? So for me, I think the best method for you to find the proxy for the net profit growth assumption is to look at the historical growth assumptions for Ivory Homemade. Let maybe during the last three years, or maybe the last year, right? So I have done some of the analysis for the companies, right? So based on the historical company's financial statement, right, the company's revenue has grown approximately 38% from 2020 until 2023, right? And the latest year growth is 52%, right? So based on these facts, we can clearly see that, okay, at least during the last 3 to 4 years, the company grow by approximately 40%, right? So based on the table here, we have two choices only, right? 3% or 20%, right? So for me, I think it is very unlikely for the companies that is growing at approximately 40% at least within a 3 to 4 year. We grow at a lower rate as 3%, right? So maybe 20% might be a more possible assumptions, or might be the assumption that might reflect the company's business status more, right? So I think by giving 20% might be a bit conservative, right? But I think it is better than 3%. Yeah. So this one will be the net profit growth assumptions, right? The next one will be on the terminal growth assumptions, right? So I think for terminal growth, there was a theory, right? So normally the terminal growth shouldn't exceed the GDP growth rate of the economy, right? So for Thailand, the economy is growing at approximately 3%, or currently it is a bit lower, right? So in this case, you should use 3% as a terminal growth rate, right? So why? You might have a question why the terminal growth rate shouldn't be higher than the market, right? So the assumptions for terminal growth rate is that this will be the growth rate for this particular companies from now on, or from the last year due to projections until perpetuity, right? So if you believe that your company will grow, let's say at 10% or 5%, which is higher than the growth of the economy, right? In the long run, because your underlying assumption for terminal growth it is until perpetuity, right? In the long run, you continuously grow at a rate higher than the economy by, let's say, 2 percentage point, or maybe 5 percentage point, right? So that is possible, but very unlikely, right? So in the financial world, we believe that from the last year, the financial going forward, maybe you will consider using the terminal growth of equivalent to the GDP growth rate of the economy. Yeah. So this is going to be the third assumptions, right? So as of now, right, there are only two analyst contenders, right, that pass all of the three assumptions. So only analyst two, analyst three, right? Next one, I think it is quite straightforward, right? So you think whether or not you should consider the capex investment, which is part of the company's cash outflow, right? For Ivory, whether or not Ivory should invest in capex going forward, right? I think this one, if if you were to grow at a rate, let's say 20%, right? You might consider need to expand your branches, right? In which will require capex, right? There are multiple types of capex, as I told you in previous classes. Expansion capex, right? You invest in the capex, you will get incremental revenue from those capex, from those capex investment. This is expansion capex, right? But there are also other types of capex, right? For example, maintenance capex, right? You need to invest in these capex in order for your business as usual operation to continue smoothly, right? This one, these are expenses you need to invest. However, that might not directly generate incremental revenue, right? And lastly, will be replacement capex, which will be long-term capex, right? So maybe you invest today, and maybe 10 time or 20 years time, you will replace those capex to refurbish to a new one. As it replace the capex, right? But all in all, I think I will require at least maintenance capex and expansion capex for the current business stage library, right? Okay. And the last one will be the IPO discount, right? So this will be one of the new concept that was introduced here, right? So normally, let me give you the answers for this the questions first, right? So in this case, the analyst tool make the most accurate or most suitable assumptions for every homemade based on time market conditions currently, right? So the answer says that you need to give IPO discount of 10%, right? So let me go through the IPO discount concept later in next slides, right? But based on analyst tool assumptions, right, we agree with all of his assumptions, five assumptions, all agree. We should believe, if we believe that the analysts to have done all the financial modeling correctly, you should believe that the IPO valuations based on analysts to believe should be at 9 billion Thai baht, right? So you should remember this numbers, right? Because this number will be used to calculate the ultimate result of this question, which is IPO price per share, right? You will use this number again shortly, right? Okay, so these are if you want to go through, these will be the key details of why we need to choose this type of assumptions, right? So these were detailed answers, right? Okay. Okay, let me go through. So let me go through. So before we move on to the next question or the last part of these questions, maybe I will go through on the IPO processes, right? And where and why they need to be the IPO discount, right? Which is one of the assumptions that analysts to choose to give minus 10%, right? So I will explain the concept IPO discount when I explain the overall IPO process, right? So based on my experience, I think there are five key steps for the IPO processes, right? So let me go through step by step. So the first step will be on the pre-IPO planning process, right? So in this case, it will be the process and all of you analysts, IPO analysts, or maybe the company's employees, you need to spend a lot of time analyzing your business model, right? So you need to think ahead. So further off, if you are IB analyst, you don't know about this particular companies before, you need to understand first what are the companies you are going to help supporting the IPO process. You need to understand the business model first. You understand what are the key business levers that will drive your business growth going forward in the future. So what are the key risks of the business? You need to understand these kind of things first, right? It is a bit like consulting, right? You need to understand your company you are facing, your companies that you are gonna make the recommendations first, right? The next step is that you need to understand what are the company's direction going forward? What are the company's short-term plan, 3 to 5 years? What are the company's long-term plan, 10 years going forward? You need to understand during these stages, right? So this will be the company's valuation. The part I mentioned is on the business part, right? On the other part, you need to do is on the financial part, right? So you need to analyze the key trend of the financial statement, whether it is a profit and loss statement, look at the margins, whether it's increasing or decreasing, how will be the potential revenue growth of the company, right? And you also need to look at the strength of the company's balance sheet, like how does the capital structure of the company work? Is more risky compared to the peers or more flexible, right? What are the composition of the asset base of the companies, right? So during this process, you analyst, you need to spend the time with the companies a very long time to understand what type of company you are dealing with. The IB needs to know at this stage, will this be a very hard task for them for the next 9 months or not, right? So this will be the first part, company evaluations, right? So this will be a very preliminary analysis, right? Maybe it will take only, let's say, 1 to 2 weeks. It'll be tough, right? But a very key time for you and a very key success time for you to ensure that all the deal will go smoothly, right? If you don't understand what you're doing with, I surely believe that you will not succeed for IPO, right? After that, after you understand preliminary understanding of the company's business or financial, right? After that, the companies might consider hiring the due diligence from multiple sources, right? So there are multiple type of due diligence that are let me explain about due diligence first, right? So due diligence is a process that the external advisors came to inspect your company in various aspects, right? So there are multiple aspects that the outsiders need to come to inspect you. First one will be business, right? Understand the business, right? So this time might be familiar with what you have done in the previous stage before, right? There's a business due diligence. Second one will be the financial due diligence, right? Financial accounting, right? You need to identify, are there any frauds, right? Or what are the key trends in revenue, right? And how are the margins, right? Are there any accounting mistreatment that the company have done in the past, right? If there is any, you need to fix it before I consider moving forward to the second step, right? The third one will be the legal, right? Any very risky litigation that the company is facing or not, right? Any probability of the company will lose a very burdensome lawsuit or not, right? So this will be legal due diligence, right? Lastly, it will be tax, right? And any tax that the company didn't pay to the tax revenue department or not, right? So we need to investigate all of these first, right? In order to ensure that the company that you are going to IPO is all clear in all aspect, right? So if you have any legal concern, any tax concern, you need to get rid of those concerns first before going to IPO, right? Okay, so I think to conclude, these are the so the first step is to understand the company and later on do some checks to understand that the company is ready to go IPO, right? After that, you do the preliminary analysis first. After that, the company may consider signing the agreement with the financial advisor, or in this case, investment banking companies, right? So the agreement will say that, okay, Patra Kasikorn SCB will be the investment banking firm or financial advisor for this IPO of company A, right? So there will be some of the key details of the contract that I will not go through, right? However, there is one key clause that I might want to outline to you, right? And this is 100% related to the IPO discount concept that I want to teach too, right? So one clause is that, okay, the financial advisors and the companies might have the commitment to they have two options to sign a commitment together, right? So the first option will be the best effort, and the second option will be firm commitment, right? So let me give you examples for you to more understand about these two terminologies, right? The first one, best effort, right? So in this case, it is related on what are the obligation of the financial advisors when they were to sell the IPO shares, right? So if the financial advisors sign a contract with the company based on the best effort, right? So if there is a scenario like, for example, you're planning to sell 100 shares of the IP 100 IPO shares, right? And after all the process to sell to every investors in Thailand or in the world, right? You can sell only 80 shares of their stock, right? So there's 20 shares remaining, right? So in this case, if you sign based on best effort, right, the financial advisors will have no obligations to sell the remaining 20 shares, right? So the company need to bear the risk that the 20 shares remaining will not be sold, right? In which might not be the most optimal case for the companies, right? However, the pros of in the company's perspective, based on best effort, is that the fee that the FA will charge to the company might be low compared to the firm commitment, right? So okay, I said to you already that firm commitment is that the fee to the financial advisor is a bit higher, right? But why the company need to pay a higher fee to the financial advisors based on firm commitment, right? Let me explain you what is firm commitment. So firm commitment is when, let me give you a same scenario, right? So you plan to sell 100 shares and you can actually sell only 80 shares, right? So because it's the same stock, right? What if you sign based on firm commitment? What will be the 20 shares be done by the financial advisors, right? So in this case, so if it were best effort, right? the company need to absorb your risk by yourself, right? However, if it is firm commitment, the financial advisor, whether it is 𝗙𝙗𝐭𝐬𝐭𝐬𝐿, it is SCB, Kasikorn Bank, they need to buy the 20 shares by themselves, right? So there is a risk that if there is a lot of shares that can be sold, the bank need to buy a lot of shares, right? In which might cost them a massive amount of money, right? So from commitment, the banks or the financial advisor will get a higher fee. However, they have a higher risk also. And they have the motivations to sell as much share as possible, right? Based on firm commitment, right? And I believe that most of the agreement between the financial advisor and the company, most of it will be a firm commitment, right? So that's why there's some incentive based on the firm commitment clause that the the investment banking firm would like to sell the shares as much as possible, right? So the easiest way for you to sell as much shares as possible is to reduce the price of the IPO, right? So that's why the investment banking firm sometimes they might give some IPO discount to investors, right? So in this case, based on the current market conditions in Thailand, right? So as you can see, the market is declining very much, right? It is possible that the companies that the investment banking firm might consider giving IPO discount, right? If the market is very bad, the IPO discount will be very, very deep, right? This is the first step, pre-IPO planning, right? After you are prepared, you are ready, right? Aspect as you've done due diligence, right? The next step will be to work with the regulators, right? So in this case, the two key regulators will be the Stock Exchange of Thailand, SET, right, and the Security Exchange Commission or SEC, right? So in this case, in the second step, the investment banking firm they'll need to draft the prospectus, right, in which later on will be shared to all of the investors, right? And after you draft the prospectus, in which you covers all the information related to your stock, right? Whether it is the historical financial statement, the business plan, who was the directors, how are the companies plan to go forward in the futures, maybe add some detail about the financial projection also, right? After that, you need to send your draft prospectus to the regulators for you to review, right? So the regulators review whether or not your prospectus is reliable, whether it is accurate or not, right? And you need to also present your findings in during the due diligence process and the company evaluation process to regulators to convince them that your stock is quite good for the public investors to invest, right? So I think for regulators, I think that they just want to cross check whether or not your stock is not a scam, right? Or you sell something that have no business potential in the future to the bond investors, right? So that's the goal for the regulators, right? So they review whether or not they will achieve those objectives or not, right? So if they are fine, they will write rubber stamp for you to move on to the next step, which is pricing and marketing, right? So after step two, one and two combined, you will have a green flag from the regulators, right? That okay, you can sell the company in Stock Exchange of Thailand or MAI, right? The next step is that you need to pitch your stock to potential investors first, right? So those steps is called roadshow and book building, right? So you maybe organize an online or offline session, maybe to a broad public or a specific amount of group of investors, depending on the strategies of the investment banking firm, or depending on the amount of IPO that you want to share to sell, right? So if you want to reach a broad base, like for example, the PTTOR stock or augmented law stock, you might consider doing the online version, right, to reach a broad-based audience, right? However, if you are very small companies and you have only a few million shares of stock that you want to sell, maybe you can organize only a small group of investors, only to the targeted investors that you plan to sell, right? So those are the process called roadshow, right? After you've done the roadshow, you have the potential list of investor that might consider uh, investing in the companies, right? But based on the booking process, they might know some way over the price of the IPO shares, however, with the PE of the stock that they're going to buy, right? However, they are not really sure how much will be the IPO price, exact IPO price, right? So the process will be that, okay, I know that the investment banking firm will know who will be the potential investors, right? After that, they will need to balance between demand and supply of the stock, right? So you know how much supply will be, how much stock will be sold, and you know how much investors that is willing to buy the stock, right? Let me give you a hypothetical scenario for this. For example, if you have 100 stock on sold and you have, let's say, 1,000 investors you want to, 1,000 investors you want to buy, right? So you can clearly see that the demand is 10 times higher than the supply. In this case, I think you are free to use the IPO price based on the financial model you have done as an IPO price, right? That is straightforward. However, if it is the opposite case, right? So we have 100 stock to sell. However, there's only 50 investors that want to buy this stock, right? So in this case, you will consider giving a lot of IPO discount or IPO discount, right? In order for you as an investment company not to not especially if you sign the firm commitment basis contract, right? Or else you will need to buy the remaining 50% of the stock, right? Which shouldn't be the case for the investment banking firm. Yeah. So this will be the pricing and marketing part, right? After you done all of this, right, you know the IPO price, you will consider actually allocate those shares to potential type of investors that may consider buying your companies, right? So there are three key types of investors, right? So the first one will be company-related investors, right? So at this, it might be the current employees of the companies, right? Maybe they got the ESOP employee stock options. They may consider exercising those options during IPO. The second might be the business partner, right? So maybe they might give the shares, the IPO shares to the suppliers in order to maintain the business relationship going forward after the IPO. That is also possible also, right? The second one will be institutional investors, or in other words, cornerstone investors. I believe you saw this terminology in the futures, right? So it's the same, right? Institutional investor or large investor, high net worth investors, private equity, venture capitalist companies, right? So in this case, they were the investors that have a very high amount of money, right? And lastly, it'll be us, right? Public investor, right? So in investment banking firm perspective, right? The priority will be given from the top to the bottom, right? So the highest priority will be given to the company related investors, right? However, even though the priority is very high, so they should be nearly 100% get the stock, right? However, normally the numbers of shares allocated to the stock is not that high. Maybe 5 to 10% of the IPO shares that was sold during those rounds, right? However, the majority of the share will be allocated to institutional investors, right? So maybe the notable stock players in the stock exchange of Thailand, or maybe venture capital institutional investors, right? So this will be the key investors for the IPO, right? And lastly will be us, the public investors, right? So yeah. And lastly, so yeah, so if you reach step 4, I think you'll be ready for the first trading day of the IPO, right? But the last step will be the post IPO, right? So the job of the investment banking firm doesn't end after the IPO bells rings, right? You need to monitor what will happen after the IPO too, right? One thing is the market price stabilizations, right? So so if you consider all the stakeholders of the IPO process, right? First one will be the investment banking firm. The second will be the company that issue the new shares, and lastly will be the IPO investors, right? So I believe that all the three goals, the incentives are aligned. That they doesn't want the IPO price to be very volatile after the IPO, right? So if the volatility is resulting in a very significant increase in the price, that might be incentive aligned also for all stakeholders, right? But however, on the contrary, if the price decline very a lot, right, that might be the optimal case for all the three stakeholders also, right? So one task for the IPO investment banking firm is to ensure that the market price is quite stable after the IPO, right? That is one task. Another part is lock-up period management, right? So for this case, if you were the investors that invest in the companies, right, and you later figure out, okay, after the IPO, all the key three management, for example, CMO, Chief Marketing Officer, CFO, and the CEO of the company, they sold all the shares right after the IPO, right? So this should be a very bad signal to the market, and surely the price of the share will drop, right? So that is why there is a concept known as lock-up period, right? So normally the key management or the key shareholders of the companies before the IPO, they will lock up their share for a certain period of time, maybe 1 or 2 years, or the in which lock-up period says that okay, they will not sell any shares within 1 or 2 years, right? So that will provide some safeguard or some comfort to the investor that okay, the key personnel or the key shareholders will not go away during these 2 years, right? So this will be the overall process for the IPO, right? So that's why there's IPO discount, right? Okay. So okay. So lastly, right? So as I told you before, you need to remember this one 9 billion, right? Which should be the target IPO for every homemade, right? But the question asked you that okay, what will be the IPO price per share? right? So in order to get the IPO price per share, you need to find the post IPO numbers of share first, right? So based on the case company, you're saying that after the IPO, the number of share will increase by 20%, right? So in this case, the number of share will increase to approximately 3,600 billion shares, right? So if I divide the equity market cap with the post IPO numbers of shares, I will arrive at the price per share of 2.5 baht per share, right? So this will be the end of question 3, right? So maybe I will continue with question 4 in the next video. Okay, thank you.